Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary at the start of this Jubilee weekend. There are plenty of reasons for gloom as we look at today's economic and political backdrop. Eurozone inflation accelerated to an all-time high of 8.1%, well ahead of expectations. Oil is close to $120 a barrel, and we can probably expect half-point rate rises from the Federal Reserve at the June and July meetings, and possibly again in September. Today is also the official start of quantitative tightening, as QT, as the Federal Reserve begins the unwind of its giant bond portfolio. Note the weakness in bonds this week. Against this backdrop, it's hardly surprising that most assets around the world have declined by double-digit amounts, including bonds, equities and such exotics as cryptocurrencies. It's even beginning to affect the UK housing market. Mortgage approvals were particularly weak. But as is often the case, markets may be now discounting the worst. In fact, world equities were actually up 4% over the last 5 days. So is this a classic bear market rally, or a sign perhaps that at the margin news is improving? We will look at these issues in the slides ahead and discuss what it means for your portfolio. So let's begin by looking at our familiar investment dashboard, showing the performance of global asset classes for the year to date. While most of the numbers are clearly negative, there has been a rally in the last few weeks. Look at the dark blue line, world equities climbing, the yellow line, Nasdaq climbing, and the green line, Bitcoin and cryptocurrencies climbing. On the right-hand panel, I've shown the US dollar index, which has moved stronger for all of this year until the last few days. That, of course, has put enormous pressure on foreign markets and emerging markets in particular. That rolling over the dollar is clearly encouraging if it continues. In the red bar below, I've shown the equity market volatility, and that continues to subside, again an encouraging indicator. So what's behind this improved market conditions and the rally we've seen in global equities of the last week or so? Well, first of all, as we discussed last week, fund managers have been exceptionally bearish. I've drawn again on a Bank of America Merrill Lynch Global Fund Manager survey, which shows what level of risk fund managers think they're currently taking in their investments. That chart is at the lowest. They're taking the lowest risk since the 2008-9 financial crisis. In other words, they're running up cash and are particularly bearish. Ironically, of course, that's encouraging for world equity markets. Secondly, the extremely dire news out of China is at last beginning to improve. I've shown in the left-hand panel the fall-off in COVID cases on the left, and obviously the good news of the reopening of Shanghai and the easing of conditions in Beijing. Also, of course, improved capital allowances, improved investment allowances, and tax cuts will all encourage a stronger than expected rebound. On the right-hand side, you can see this is beginning to flow into Chinese asset prices. First of all, the Chinese currency is beginning to strengthen as the dollar weakens, and at last we're seeing a rally in Chinese equities from the persistent falls that we've seen over the last 12 to 18 months. Thirdly and finally, there's just the possibility that US inflation indicators may be peaking. I've shown in the left-hand panel the US Inflation Surprise Index, which compares analysts' forecasts of inflation to the actual outcome. And you can see that's beginning to quite materially roll over. And of interest, I've compared that to the UK Inflation Surprise Index in red, which continues to climb strongly higher. On the right-hand panel, I've showed the Federal Reserve's preferred measure of inflation. They call it the PCE deflator. And while the slowdown there is very modest, you can see that perhaps we may have peaked. Put these all together and you can see why conditions in financial markets have improved, and you can see something of the reasoning behind the recent rally. What I would say though is we're not out of the woods, and I particularly like to focus on the problems of inflation here in the UK. On the left-hand panel, I've shown a chart from Michael Saunders' recent speech. He's a member of the Monetary Policy Committee, where he looks at the sources of pricing pressure for companies across the UK. Raw material costs, utility costs and shipping and transport costs are obviously outside the bank's control. They're driven by international factors. But look at that pink line at the top, the pressure on labour, and we can see it in deteriorating industrial relations and the likelihood of a wave of strikes in the months ahead. Part of this is being driven by a sharp fall-off in the UK labour force, rather as we've seen in the US. 440,000 people have retired from the workforce since the eve of COVID on the 31st of December 2019. Interesting, a lot of older people have retired, while many younger people are complaining of long-term health issues, perhaps a long-term COVID issue. Without the safety valve of European inflows, of course, post-Brexit, that's putting huge pressure on the underlying labour market. So it makes us worry that the Bank of England is going to have to be a little more hawkish, as indeed many central banks around the world are going to have to be. While we have a base case of UK interest rates rising just to 1.5%, our hawkish case shows them rising to 2.5%, which of course will put considerable pressure on household budgets as mortgages have started to rise substantially from their low levels today, and of course a challenge for the UK housing market. So let's summarise our policy. Despite some encouraging early indicators in the world economy and the excessive bearishness of fund managers, we're not ready quite yet to add to risk assets. Why? We simply feel that the policy tightrope that central banks have to tread is too uncertain between taming inflation on the one hand and triggering recession on the other. So we remain sharply underweight government bonds as quantitative tightening becomes a reality around the world, still modestly underweight equities, overweight alternatives, particularly those renewables and infrastructure, with a precautionary position in cash so we're ready to move fast if conditions change. Well, I hope that's helpful. I hope it helps you to balance the risk and reward in world markets today. And most importantly of all, can I wish Her Majesty the most wonderful Jubilee weekend, and may the British weather and the British public be behind her. Thank you.